The Rebel Capitalist Show.
All right, guys, it gives me a great deal of pleasure to welcome someone back to the Rebel Capitalist Show that I always look forward to speaking with. His name is Jesse Felder. Jesse, welcome back to the Rebel Capitalist Show, my friend.
Thanks, George. Glad to be with you.
Okay, now, the topic on everyone's mind right now is social media and what's going on. Whether you like what's going on, whether you don't like what's going on, probably the majority of my viewers really don't like it, but I know you've really studied this extensively, and not really what's going on with kind of the so-called purge, but really about the effects of social media on psychology and how these big social media companies could be kind of dangerous for the future, not only from a financial standpoint with markets, but also with our society. Can you expand on your research?
Yeah, I mean, it's, I've just read, a lot of people have done a lot of work in this space. And I interviewed for my podcast, Roger McNamee, maybe it was 3 years ago or something on this topic, because he was really one of the first major investors in Facebook. And he was one of the first people to kind of raise the alarm here about what's going on. And it's really comes down to these kind of, like intellectual silos that people, find themselves in, where it's just, an echo chamber of one-sided views. And, what social media platforms, and really, probably everybody remembers who's been on Facebook, when their feeds started changing from just a chronological feed of, the people that they are friends with and seeing what they're up to this curated algorithmic feed of Facebook showing you what they want you to see rather than what your friends are up to. And that was, a few years ago, maybe 4 or 5 years ago. And the other platforms went in that direction. And what that did was, rather than just seeing, and this is something probably, everybody should do, is that my Twitter feed is just, you can set it to chronological or you can set it to algorithmic. And I think it makes a huge difference to when you just look at it, the chronology. And it's because what the algorithms are trying to do is they're trying to show you the things that will create the most engagement. What is that creates the most engagement? Usually the things that are the most extreme type of views, whether they're true or not. And so what you end up happening is, it's like when the news media went, towards more and more towards sensationalism. I think CNN was a good example. When we got the 24-hour news cycle, all of the news, companies had to get more and more sensational to try and, get eyeballs to their, and so
Eating with the internet.
Yeah, and so basically that's what these algorithms start to do also, is we need to try and drive engagement. And we do that through sensationalism, but that's at least what the algorithms do. And so people, rather than seeing kind of a realistic view of what's going on in your networks or in the news or world, you're just seeing this sensationalized version, and social media is kind of that on steroids. And so I think it really, I think a lot of the anger and stuff that we're seeing, fueled on both sides, is not unjustified. It's absolutely justified, but it's being magnified and exacerbated by social media.
Yeah, and how do you think that you said the word or the term echo chamber? And I've been thinking about that a lot, because you always hear that the old saying from all the OGs that preceded us, that the markets can remain irrational longer than you can remain solvent. But that was prior to social media and this echo chamber, and prior to TikTok and Instagram. And I don't know if you've seen recently on Twitter, it's been all over the place with these people, these kids on TikTok coming out and saying that they take how to take your $600 stimmy and turn it into $13,000. Grant, posted that one, or one that was posted yesterday by my good buddy Jason Burke, or he retweeted it, I think. It's this couple, younger millennial couple, talking about how, here's my strategy in a nutshell. All I do is I buy a stock, I wait for it to go up, and then I just sell. It's easy. Everybody should be doing it. But my point is, do you think that social media and these echo chambers have exacerbated the current bubbles we see in financial assets? And could they keep on going and growing larger than they ever could before because of this social media phenomenon?
Yeah, I mean, it's a good question. I think there's absolutely no doubt that the echo chambers, these social media echo chambers, are having an effect on the markets right now. We've never seen, it's actually really similar. If you think back to the dot-com mania, we had the Yahoo message boards, and these were like the early days of the internet. They were much, simpler and, than Reddit today, for example. I think if you got to look at, if we're talking about social media affecting the markets, TikTok Investors is, one of those Twitter accounts that, you just have to follow right now because, you're basically seeing, what are the stimmy trades, and you're realizing how many people are taking $600, putting it into Bitcoin or Tesla call options or whatever it is. But to me, I think it was just today, my friend Peter Atwater pointed out to me that there's a new Twitter account representing Wall Street Bets, which is a Reddit, essentially message board.
Can you go into that, Jesse? In fact, I just, in my member forum, I did a live stream last night with Lynn Alden, who's my partner in that. And she talked all about that I guess it's a subreddit. I didn't even know how it worked. And she said that they're going in and kind of like aggregating a group of people and like crowdsourcing and trying to do these where they going in and with the short covering.
Yeah. Well, Lynn tweeted something last week or the week before about GameStop. And she said, oh my God, look at GameStop's up like 50, 60%. And I just replied to her, I said, go check out Wall Street Bets, because that was their big thing, is essentially a lot of these. So it was really interesting to me today to see this Wall Street Bets moderator create a Twitter account, because they announced themselves on Twitter and saying, we aren't just these crazy, traders. You have to take us seriously. We're now moving markets. And, that's very interesting from a sentiment perspective. But it's also true that, for a little over a year now, at least, the collaborative buying that this group represents has been moving markets. I mean, I think they've been very heavy in the Tesla call option trade, not to mention other call option trades. And they understand that if we all buy enough calls together, and you're seeing 2.5 million call options at Tesla trade every day, it's insane. It's bigger than anything we've ever seen before. But if we buy enough call options together in concert, then we force the market makers to be short calls, and they have to go buy underlying Tesla common stock in order to hedge their short call position. Right. And all of that synthetic buying by just option dealers forces the stock price up. So I think that's a big reason why I've seen Tesla go up 1,000, 1,100% over the last year, is you've seen so much massive call buying that forces this underlying, these option dealers to buy the underlying. But more recently, we've seen these Wall Street Bets, traders turn their attention to stocks with big short interest. So
to make that short squeeze, to make it pop.
Yeah, I mean, to me, I started buying Bed Bath & Beyond stock over the last couple of years when it got extremely cheap. It got down to $3-4 a share back in March, and it almost hit 30 recently. And Wall Street Bets guys, I think, hopped on this trade for a little while, but Bed Bath & Beyond got to the point where almost 80% or over 80% of its float, the tradable shares, were sold short. And that's such a massive short position that if they ever try and cover that, you're going to see the stock go up tenfold. And that's what we saw with Bed Bath. It's what we're seeing with GameStop recently. And except this hasn't just been, kind of a natural course of events where Bed Bath & Beyond's not going to go out of business. And so people realize, okay, maybe I shouldn't be short. This is a concerted effort to squeeze the shorts by Wall Street Bets, where they say, okay, we're going to come in, and maybe we'll do this Tesla trade with GameStop. And we'll buy, thousands, tens of thousands, hundreds of thousands of GameStop call options, which is going to force the option dealers to go buy underlying GameStop stock, starts pushing the share price up, and the shorts go, oh no, we're going to get squeezed big time. And then you get GameStop going up 50, 60% a day. And so, yeah, there's some crazy stuff going on. It is all kind of, wrapped into this or driven by social media in a lot of respects.
Man, number one, is that legal?
To me, it seems like market manipulation, right?
Yeah.
They know. So to me, that's also why I was curious to see them come out on Twitter today, create this Twitter account and say, we are moving markets. Because to me, that's almost like an admission that they are manipulating the market in their favor. There's so much of this type of stuff going on right now that it's only going to be, I just wrote a blog post today that there's so much outright fraud going on in the markets right now, and so much of it's being revealed. It's fascinating to me that, it took the dot-com bust for Enron and WorldCom frauds to be revealed. It took the great financial crisis to understand the extent of the mortgage fraud that was out there, and for Bernie Madoff's hedge fund fraud to be revealed. It's not until we see another major bear market that we're going to see just how much truly fraudulent activity is going on right now. I think it's like much of what else is going on in the world today. It's totally unprecedented.
Okay, so here's a curveball for you, and I just did a video on it, so it's fresh on my mind. If what it requires is the market to crash down, so what's Buffett saying, that when the tide goes down, you can see who's swimming naked, something like that.
Yeah.
What if or is it possible for the market to crash up instead? In other words, for the rate of inflation to exceed the rate that the market's going up, but the market still is flat or going up in nominal terms. So it's basically crashing up. But would that have the same effect as the tide going down, or would the tide just always stay up?
Yeah, I don't know if that would have the same effect. Just to be clear, I think the first person who proposed that theory to me was Luke Gromen back in late 17, early 18. He and I talked about it a little bit, and that was kind of his theory, was the market was melting up as a product of kind of an entrance into inflationary, hyperinflationary type of trends. And I thought at the time, the only way that that's possible is if you're really seeing inflation in corporate earnings, inflation in commodities, and inflation in these other things, right? You're not going to see it just in asset prices.
Right.
And so to me, we are now seeing it in, food prices and commodities. So, maybe it is more of a possibility. Today, I think probably what's astounding to me is that normally these frauds are only uncovered during a bust. Like you mentioned the great Buffett, but a lot of these frauds are being revealed even during a market boom. We're seeing like Wirecard. Last year was a huge one. Luckin Coffee, another one where they, just cooking the books. But we've seen some other ones too, like Nikola, kind of with this fake product, right? They have the truck rolling downhill, and it's not even moving under its own power. And then just last week, I saw this space company, and they showed that they were taking delivery of some, rocket, and it was completely falsified photo. I mean, they're trying to gather investment dollars by, with fake products. And to me, it's fascinating that so many of these things are being revealed now, and the market hasn't even, really gone down. So I don't know, to answer your question, I think, we really won't know the full extent until asset prices go down, because there's a dynamic, and, the Manias, Panics, and Crashes is a great book. Charles Kindleberger talks a lot about this, where it's only when you start seeing asset prices go down where all of these frauds, people realize, oh, wow, my fraud's about to be uncovered. I need to quickly grab the cash while it's still available. And so it's that almost like a run on the banks type of thing. And that's, asset prices starting to fall kind of precipitate that move to grab the cash and get out while the getting's still good. And so I think we really won't know the extent until asset prices start falling. And then at that point, we'll see that trend towards not just the fraudsters, but investors, of all, types, realizing, wait a second, If that's a fraud, then this other thing I invested in could also be a fraud. And that's where you kind of get a panic like we saw during the great financial crisis.
Yeah, I'm sure the viewer right now is just asking themselves, well, my gosh, can the stock market ever go down? Because it just seems, that's what I get in my comments all the time, that just the Fed will never let it go down, or the government will just spend as much stimulus as they need to spend to make sure that the market is elevated forever, or at least in nominal terms. I mean, is that thinking flawed, or what's your opinion?
I think that there has been that question about, can the Fed do this forever? Is there an end to the money printing? Is there a limit to it? And, I've talked to, Bill Fleckenstein has talked about this for a few years, that he thinks at some point the bond market will take the printing press away. In other words, inflation will rise, interest rates will rise, and, the Fed will have to turn its attention to fighting inflation rather than trying to prop up asset prices. Now, there's been talk about yield curve control,
right?
Which, the Fed is basically saying if that scenario happens and interest rates start going way up, we'll just, we can just cap yields across the curve. We can say 10-year yield should be 1, 30-year yield should be 1.5, and we'll buy enough to keep, enough of those treasury notes and bonds to keep, yields at those levels. Now, if they were to do this, and this is why I think they're not, they've been asked about yield curve control, and they're not really talking about it yet, because I think if they do that, the one outlet, there's got to be some outlet, right? The outlet for that would be the currency, and we would see the dollar. I think if we start seeing inflation taking off and they implement yield curve control, the dollar is going to go straight down. And I really do think the dollar decline we saw last year is kind of a hint at that. Like, if you guys are just going to monetize trillions of dollars of debt and cap the yield curve so that, bonds won't be able to reflect the true inflation risk, the outlet is the dollar. And so I think really the dollar is the thing that could take the printing press away. It's why I've said for the last year, the dollar is the number one, price to watch.
Yeah, for sure. And I did a video on that because everyone looks at the DXY and sees the dollar go down by, let's say, 10% from 100 to 90, and they say, oh my gosh, the dollar is crashing. But I also like to point out that there's a lot of nuance in the dollar, quote unquote, crashing. And I said, well, look what the dollar has done relative to Bitcoin. That is a dollar crash right there.
Yeah, absolutely.
Look what it's done compared to real estate or goods and services. There's a lot of the devil's in the details when you look at stuff like that. But let's go back to kind of the indicators that the market's in a bubble. Have you done much research, or do you have an opinion on the SPACs that we're seeing? I mean, I don't watch CNBC that often, but it seems like every single time I turn it on, there's a specific guy on there talking about the new SPAC that he's set up to buy XYZ company. That's what's interesting on that note is I listened to the people who are kind of more bearish on Tesla, and a lot of the people really don't come from finance. But what happened is Elon Musk stepped into their territory where they're an expert, and they said, whoa, wait a minute here. This guy, no, it didn't work like that. And the same thing happened for me the other day when I was watching CNBC, and this promoter I'm talking about set up a SPAC to buy a real estate company. And that's where I'm an expert. And he started going on in this pitch, and I'm like, wait a minute, that's not how it works. But anyway, what are you?
Yeah, no, the explosion in SPACs or blank check companies is probably the better way to explain them, is just completely off the charts. It's a testament to the manic risk appetite in the markets right now, that people are willing to just write a blank check to whoever it is, to whatever they want to invest in. Mm-hmm. We've never seen anything like it. I really like, I mentioned Peter Atwater before, but he says the chart of SPACs is interesting because you see, it's like nothing, and it explodes last year into a huge, bar on a bar chart. Yep. He said, eventually we're going to look back at this and it's going to look like a huge middle finger on the chart. And I think that's like that is the perfect analogy, because SPACs are some of the worst, proven to be some of the worst possible investments you can own. The performance of them is usually pretty terrible. And, I was talking about fraud before. To me, they're kind of borderline fraudulent, really. When you look at the compensation, it's no wonder everybody wants to start their own SPAC. If you get whatever it is, 20% of the value of it just by sponsoring it. I mean, you can see why, everybody and their mom wants to create a SPAC, because there is nothing else in the financial world where people are willing to just hand you over money, do whatever you want with it, and we'll compensate you with 20% of all the money you raise as, a reward for this. It's only at the height of speculative mania would you ever see anything close to this kind of popularity for SPACs.
Yeah, and I think from what I've read, it gets around a lot of the I don't know if I want to call it promotional rules, but I know when you're taking a company public, the CEO can't really go out there and sell it. You can't go out on CNBC and say how great it is. There's a lot of regulation around that. And I read that somehow the SPACs get around that completely, where you can talk about it, you can just pump it and pump it and pump it. And it gets around those laws. So
yeah, I mean that's a good point. I mean that's another reason for the popularity of those is like when people are writing you a blank check to do whatever you want with, the SEC is recognizing, okay, people are essentially giving up all of their rights to due diligence or anything because you're just writing a blank check. So yeah, the regulatory requirements are totally different. Like with an IPO, it's much more restricted, and that's a big reason why so many companies are essentially going public via SPACs, because it's so much easier to just get bought by a SPAC than it is to create your own IPO.
Yeah, exactly. Then, what that takes me back to is social media, because then you have the SPAC promoter. Whoever wins is the guy or gal with the largest social media following that can influence the most amount of retail investors. And it just, I don't know, man, it gets crazy. So, one question I wanted to get your opinion on that I've been thinking through is if we go to this yield curve control, the Fed is technically trying to peg the yield curve for treasuries. But in a free market, if I understand it right, there's a risk premium that the market would place on things like future inflation expectations. So like mortgages, as an example. So if they peg the 10-year at, let's say, 2%, can we still see mortgages go up to 7-8%, a lot higher than they are today, if the market sees that inflation expectations? That, number one, is it possible? Does it work that way? Number two, do you think the Fed would just come in and start buying all the mortgages to bring those rates in the real economy back down?
Well, I mean, it's a good question. I think, probably mortgage companies use the treasury curve to, as their cost of capital, and then also to hedge, risks. And so I think probably mortgages are pretty closely tied to the, the treasury curve. But I do think too, though, that it is a slippery slope, right? I mean, if mortgages, start rising, and the Fed is buying mortgage-backed securities now, they're buying a lot more treasuries. But then that also opens the questions for, corporate bonds. I think that's probably even bigger question than mortgages, is if the Fed, the Fed is not buying corporates, then spreads could widen. And, that when spreads widen, that's usually a good indicator of recession. It's also a good, correlation to stocks. So widening spreads usually means equities are, going to be stressed also. And so I think probably what that looks like is, if they cap the yield curve, then those other questions are, where do they stop? Are they going to have to come in and support the mortgage market again? Are they going to have to come in and support corporate bond market again? And even Janet Yellen has talked about, not just those things, but buying stocks directly. And so it may turn out that during the next recession or, stock market sell-off, the Fed has to come in, not just, buy treasuries, but mortgages, mortgage-backed securities, and corporate bonds again, and maybe even stocks. Because right now the Fed has set up this, and the St. Louis Fed, I think, put out something recently to this effect, saying that when stock prices and asset prices become elevated, it opens up a risk to the Fed of a potential negative wealth effect. That if asset prices decline, that in itself can create a negative feedback loop for the economy. And so the Fed has created this trap now where they've boosted asset prices, but they can't let them normalize. And so, because letting them normalize means, we're allowing for all the economic pain we tried to prevent during the last, sell-off. And so I do think the Fed is trapped into supporting all of those things when they all begin to. So yeah, I do think the Fed will have to come and support mortgages, corporate bonds, and maybe even, buy equities, because they can't afford to allow asset prices to decline. Just as the economic impact would be too significant.
You see, that takes us right back to the fraud. So if they do all these things, so the more the Fed intervenes, the more they try to prevent the market from going down by doing all these crazy things, the more fraudsters we'll have that will gravitate towards that and take advantage of those retail investors. I mean,
yeah,
that's really the
unintended consequences of this extreme monetary policy are just spiraling out of control, really. I mean, you've seen, the number one thing that people are, I think, talking about in terms of this discussion is the widening wealth inequality, right? I mean, by the Fed specifically targeting asset prices, and they know, that's going to benefit, the wealthiest the most. The wealthier you are, the more that benefits you. That is becoming more and more of an issue, that disparity. And it's having political consequences. But there's the other, consequences that you mentioned too, which are various. I mean, one example is by buying up corporate bonds and allowing all these companies to issue new debt at record low interest rates, you're propping up all these zombie companies, which should go out of business.
right.
And it hurts the productivity of the overall economy big time when you allow for all this debt creation and all these companies to, just keep operating when they really shouldn't. I mean, we really need that creative destruction for the overall health of the economy. And so there's that. And then, obviously, too, that when the Fed, there's the moral hazard involved of, we are going to come to the market's aid every time because we can't afford to let asset prices fall, means everybody and their mom goes, the Fed won't let asset prices fall. Just like you said, that's the number one question you get. As a result, I can speculate in the most speculative of securities.
Let's max out my credit card. Let's max out my credit card and buy Tesla.
Absolutely. I can buy, and there's a great example of that. Wall Street Journal ran an article about a guy who, was essentially had no money, was, mid 60s, retired, close to retirement, and was worried, what is he going to do for his retirement? He bought a bunch of Tesla call options and made $2 million. And now he just sold his house and is margining his, Tesla common stock to go buy more Tesla call options. And this is the type of behavior that the Fed is, supporting, is encouraging. And at some point, it's just like, you may remember Alan Greenspan in the early 2000s encouraging people to go take out adjustable rate mortgages. Right. He goes, we're going to keep interest rates low. Go ahead and, in 2002, 2003, go take out that 5-year ARM. Don't worry about it. And then he went a couple of years later and raised interest rates. All those ARMs, that was part of the reason why stuff collapsed, was people bought, I'm going to buy 5, 6, 7, 8 houses with these ARM loans because the interest rates are so low in the beginning. Then after that 3-year period expires and interest rates go back to market, and Greenspan's been raising rates for 2-3 years, now all of a sudden those people, have no way, of making those payments, and the whole thing implodes. I think we could see something similar with the Fed encouraging speculation. At some point, they're going to be prevented from coming into the market's support, due to inflation or whatever else that, is going on. It could just be a political change that due to this rising polarization due to wealth inequality and things. But at some point, all of this speculation the Fed's encouraging is going to come back to bite them and speculators, just like it does every cycle.
Yeah, but they're forcing more and more people to gamble or to be gamblers, to go to the casino. And I just think of the misallocation of resources. And it's, resources isn't just oil and copper. It's your time as a human being. And I just think back to that TikTok video we were thinking of, and I remember the gal saying that this, because my husband goes in there, just buys it, watches it go up, and then sells it when it starts going down, we're able to quit our 9-to-5 jobs. And so think about all the people that would be out there training for a productive job to where they're creating goods and services in the economy, but aren't doing that anymore because the Fed has forced them to basically go to the casino and play slot machines on leverage. And if you're a believer that the true wealth in the society is the amount of goods and services it can create efficiently, it just seems like we're just going down this path where our society is creating fewer and fewer and fewer goods and services, and we're only getting more wealthy in terms of paper, but not real wealth. And it's just, I don't know, it seems
that's absolutely right. And another point that I would make is that they looked at how people, these stimulus checks. And what I thought was astounding was the lower your income level, the more likely you were to speculate with the $600 you got. So the lowest income levels were the most likely people to put that $600 in a Robinhood account. And I think that comes back directly to the Fed and basically showing people the only way you're going to, achieve the American dream today is through this crazy speculation. Yeah. And the sad part about it is those people will be hurt by far, more than the people who are speculating less or people who have, true wealth. It's to me, it's a mindset we're seeing not just in speculating, but we're seeing it in almost every aspect of our society where we used to believe, or I think most of us do believe somewhere, inside that there is no gain, no pain, no gain is a real thing, right? You have to put in the hard work to reap the rewards later on. Right. In so many, respects right now, we're seeing people saying, you know what, I want to skip the pain. I just want the gain. And so that's this speculating and things, and they're not realizing, okay, when you put the gains first, the pain's going to come. It's just going to come later on, and it's going to be even more significant than if you had, worked hard for that in the beginning. But I think we're seeing that too with monetary policy and fiscal policy now too, especially, which is the Fed has said, rather than taking our medicine and allowing this, the dot-com bust to work through the system, the economy to reset, or in the great financial crisis, the companies that should have gone out of business, rather than letting them go out of business and the economy just go through its natural process, we prevented all that pain and try and get straight back to the gains. And yet today we're seeing that with fiscal policy, I think, where we're saying we just want to give people cash, money, checks. We're going to print the money, we're going to send it to them, and hopefully that's going to create, sustainable economic, boom. But the pains come later on, right? I mean, yet we need to help the people who are really struggling right now, people who are food insecure and all these things and lost their jobs. They do need assistance. But when all this money is just going into the stock market, we're creating these false gains. We're creating a sugar rush. And the aftermath of this, the pains that are going to be created are various. I think we could see, an asset price bust, as when all of these checks go away. You asked me earlier and I didn't answer, how do you know, when this is going to stop? Mm-hmm. Well, for it to sustain, for a bust or a boom like this to sustain, it requires more and more and more people and more money coming in to push prices higher and higher. So at some point, you run out of people and you run out of money, and we're going to get there. There's no way of really knowing when that point is, but we're going to get there. You can't grow exponentially forever. But with fiscal policy, too, there's a real, chance that what we get is an inflationary kind of boom in the economy, but it's really kind of a false boom. It's more of a stagflation where the economy has a sugar rush and then it kind of settles back down to its normal level, but we're still left with higher inflation. Right. And that would be a very difficult outcome that I think people don't appreciate right now, but is becoming a more and more real possibility. As a result of this, we don't want to take any of our medicine. We don't want to let the natural way of things work through a recession. We want to prevent all that by printing money. You're just making greater pains down the road, and I don't know exactly what those pains are going to look like, but I fear it could look stagflationary at some point.
Yeah, Jesse, the psychology is fascinating to me, and it's hard for me to articulate. I haven't been able to do a good job of it, but I think you and I are probably about the same age. How old are you?
46.
I'm 47. So, and I actually grew up in Portland, Oregon, just outside of Portland. But when I was growing up as a kid, I mean, first of all, like just a small example, was like bicycles. Nobody wore a helmet. I mean, what are you talking about? And when I was like 8 years old, I mean, I would be gone the entire day with my friend riding my bike like miles into the hill. My mom would have no clue where I was. And I always make the joke that with my group of friends, if you would have shown up wearing a bike helmet, that would have been far more dangerous because you would have got the shit beat out of you. But and then we got this helicopter parenting that we started to see in the 1980s, 1990s, and now to the point where you can't even let your 13-year-old kid out of your sight without going to jail or whatever it is. Have we taken helicopter parenting from the household level to the fiscal and monetary level?
It's a great point. I wrote a piece maybe like 2 years ago on this very topic because Simon Sinek gave a little talk. And he's a brilliant guy. I really think he's an interesting thinker, where he was talking about this, how that the millennial generation has been raised so differently than we were. And you and I learned, through hurting yourself, crashing your bike, whatever. I mean, all those kinds of things. And, it was kind of like the philosophy for parenting back then was, this is the parenting philosophy I've tried to have because I've seen other kids, kind of be damaged by parents who say, I don't ever want them to fail. I don't want them to make any mistakes. Well, how are you going to learn anything, right? I mean, you can tell kids, this is the way it is, and this is why you should do this, but it's in one ear out the other for most kids. And until you actually go through and feel the pain of the consequences of your actions, you don't actually change your behavior. And you're absolutely right. The title of my piece was Millennial Markets. Was the Fed has essentially acted as Helicopter Ben, right? He was called Helicopter Ben for money printing, but when you prevent markets from ever feeling the consequences, you prevent speculators from feeling the consequences of their actions. You prevented, much of Wall Street from ever feeling the consequences of the great, the great financial crisis. It sets up these, parenting is a good example. It sets kids up with the idea that they can't ever fail. They can't make mistakes. And so, they're overconfident.
They never feel pain.
Yeah.
So that becomes the priority, almost a religion that we just can never, ever feel pain. So if it means printing money, distorting the economy, it just doesn't matter. We just cannot feel short-term pain.
Yeah. And eventually, that can lead to some very bad outcomes because I know for myself, I learned some really important lessons as a 10, 11, 12, 13, 14-year-old kid by making, major mistakes that, inform my actions now as a 46-year-old. And if I hadn't made those mistakes as a kid and learned those lessons, then I'd be making them those same mistakes on a much, much bigger, more dangerous scale. And so,
but also, Jesse, I'm sorry to cut you off, but we've also learned a ton of lessons as adults by losing money. Well, like you've been an investor, I was an entrepreneur for many years. Trust me, I had a lot of businesses that failed, and I learned a lot more from those failures than I probably learned from my successes. And there's no way I would have been as successful if I wouldn't have lived through those businesses that failed. And I would assume it's the same as an investor.
No, it's absolutely right. I mean, that you go study any of the great investors, and they'll all tell you that it's only through, making those mistakes and then promising themselves, I'll never do that again, that they actually learn how to be, successful. I mean, you read Market Wizards, and every one of those guys has a different, way of making money in the markets. But almost every one of them lost everything at least once early on in his career, if not 2 or 3 times. You go losing everything, and you realize, okay, what did I, look back, what did I do wrong? I will never do that again. I'll never put myself in that position. And so, that type of risk management, that type of discipline is something that you just don't see. I mean, you listen to Paul Tudor Jones, and he says, defense first. That's the most important thing. Warren Buffett says the same thing. Rule number 1, don't lose money. Rule number 2, never forget rule number 1. I mean, all of these guys have that same mindset of,
Right.
protect what you have. Yes, take risk, but do it, And what we're seeing in the markets today is the product of people never learning those lessons, is never having that experience. And so they don't have that mindset where they're thinking about risk management and defense first. It's just the last thing on anybody's mind right now.
Yeah, we've pulled that learning experience away from everyone.
That's a great way to put it. When you are a helicopter parent, you deprive the child of learning lessons on their own.
Yeah.
You're really hampering and hurting their development. And that's what we've done to markets. Same exact thing.
Yeah, I hear so much on Twitter instead of, I'm always kind of the promoter of kind of that Buffett philosophy. It's just protect your capital, and the first rule of investing is don't lose money. But the feedback that I always get from people is, well, if I would have done that, I wouldn't have invested in Tesla a year ago, and I would have missed out on all these gains. It's like the mindset always goes back to, well, okay, I mean, I get it back in the 80s, but now if I would have had that mindset, I would have missed out on the S&P going up, 10 times or whatever. I would have missed out on all of these gains. And it's difficult for people to understand probabilities. And it takes me back to my days in blackjack. And if you just keep doing things, if you don't have an edge, and if you play the game long enough, you're going to go bust. And just know, I think people would be very well served right now to ask themselves, what's your edge? Like if you're a retail investor that's taking your stimmy check to buy XYZ company, what edge do you have over any other person? And if you don't have one, then you're gonna lose over the long run. What do you think about that? Because going back to the Market Wizards books, they always talk about having an edge. You got to have an edge, a mathematical edge, and you never hear that today.
Yeah, no, you're absolutely right. You have to have an edge to successfully make money in the markets over a period of time. I would say in a market like this, you actually don't need an edge. Yeah, I mean, literally, you look at anybody and everybody who is buying any kind of stocks is making money. And I would say don't confuse brains with a bull market is, a famous adage right now, is that this is just a bull market. And so everybody, you can do anything you want to make money. What I would say is, if you had some type of risk management, it doesn't mean it's going to prevent you from buying Tesla before it goes up 1,000%. What risk management means is you have a process to sell it before it goes back down 90%. I think people don't realize if Tesla went back to where Elon Musk said the stock price was too high, it would have to fall 85%. The stock price today would have to fall 85% to go back to where Elon Musk said the stock price was too high. So if you don't have some type of risk management to say, this is when I'm going to sell, this is when I'm going to cash out. And that's, to me, the mindset that is most important, is you see so many people saying, I love Tesla, I'll never sell it. I mean, there was another good example of a Tesla guy, I think he made $12 million owning Tesla over then good for you. I mean, that's amazing. But his plan to retire from his job on his Tesla gains is to margin, I think, up to about 30% of his Tesla in order to pay his, ongoing living expenses.
On Twitter.
To never sell a share. And that's the type of mindset when you fall in love with the security. It means you've lost touch with reality, right? There's no reason to fall in love with anything. There's a good discussion of this in the book The Money Game, which was written back in the 60s, kind of during the Nifty 50 era. And so falling in love with any type of investment is an error. And you have to have some type of methodology or discipline to say, when this happens, this is where I sell. And if you don't have that, then you risk giving back all of those gains that you made. And it won't necessarily prevent you from buying the next Tesla or whatever, but it'll prevent you from giving back everything you made, in owning Tesla or whatever it happens to be.
Yeah, and what I think about that example you're referring to, I believe was on Twitter. I think I saw that gentleman's tweet. And what I thought about when I saw that is how many people are increasing their purchasing power as a result of something that has nothing to do with them increasing their productivity. They're not going to work an extra hour. They're not doing anything else, but somehow their purchasing power is increasing tenfold. And I'm not taking anything away from that gentleman or anyone who has made money. It's what we're here to do, is make money in the markets. But at a certain level, you ask yourself, how is that sustainable? How can we just sit at home and get exponentially richer without doing any more work? And I guess the bottom line is it's not.
Yeah, I mean, the Fed would like us to believe it is sustainable. You look at household net worth to GDP or net worth to disposable income, and it's off the charts. Yeah. And I remember 3 or 4 or 5 years ago, an ex-Fed research official came and said, "This is the indicator that we're in a bubble. Is just household net worth cannot grow faster than the economy indefinitely." And that's what I think. That's your point. Is this can only go on for a certain amount of time, where prices and asset values grow faster than underlying fundamentals, whether it's the economy, cash flow, net asset values. This can happen, but it also goes in reverse too, where asset prices need to come back to earth, and that's that's going to happen at some point. To me, it's fascinating because it feels like the market's just gone straight up for the last 3 years, but we had this 2017, early 18 ramp, and then we had Volmageddon, which was a pretty interesting crash where the short vol trade blew up. Then we had 2018 rally, and then towards the end of 18, with Jay Powell raising interest rates, the stock market fell pretty dang hard into the fourth quarter of 18. Then Jay Powell changed course, said, okay, I can't afford to allow spreads to blow out, companies to go bankrupt, all this. We're going to change course, start QE again. Market rallies from late 18, early, I guess it was Christmas Eve 18, market bottomed straight up until February of last year. And then we saw, the quickest, the fastest and steepest stock market crash in history as a part of the pandemic. And as a part of this whole thing, we've created this broadening top pattern, megaphone pattern, whatever you want to call it in terms of technical analysis. But when you read Edwards and McGee, which is technical analysis of stock trends, they wrote this years ago. This pattern is indicative of a market that's out of control. And that's, to me, the best example of what's going on here is we have out of control speculation, which ends up in a short vol blow up, early 18, Fed comes to the rescue. Then we had the natural probably recession starting to unfold in late 18. Fed comes in, tries to prevent that. Then we have a pandemic crash. The Fed tries to, come in, but this market is out of control. And those broadening top patterns are always topping patterns. And I'm not saying that, technical analysis is infallible or anything, but to me, it helps explain what we've seen over the last 3 years better than anything else that I've seen.
Yeah. I could go a lot of different directions here. We think about, or I think about the Venezuelan economy. I've got a lot of real estate and I do a lot of business in Colombia, and I've got a lot of employees, in fact, that fled Venezuela, the hyperinflation. And there's a lot of problems there, of course, but one of their main problems is they built their entire economy around one thing. So if that one thing crashes, you got big problems. And it just seems the more I look around the United States, the more it seems like we're doing the exact same thing, in the sense that we're building our entire economy around one thing, and that's asset prices. But like oil did in Venezuela, at some point those asset prices can come down, and then you bring the whole economy down with it if you got all your eggs in one basket. But that takes me to my next question. I was listening to your recent podcast interview with our good friend Danielle DiMartino Booth. And for anyone who doesn't listen to your podcast, I know you don't do too many episodes, but it's well worth subscribing to listen to the episodes you do come out with. But you guys started talking about MMT and something that I've been trying to think through, and that's Janet Yellen becoming the Treasury Secretary. And kind of one of the first things you do with MMT is you want to combine the balance sheet of the Fed and the Treasury. So now you can turn these bank reserves into legal tender, to use Dr. Lacey Hunt's terminology. And I thought, my goodness, if I wanted to do that, the first person I'd hire is Janet Yellen. I think you guys said kind of the same thing. So I know you've probably had time to think about your conversation. Can you expand on that?
Yeah, so I think MMT started in late 2019 when the basis trade blew up, which was hedge funds using the repo market to leverage up spreads on treasury bills into tens and billions and hundreds of billions of dollars. And when that trade started to blow up, and we saw, basis rates just kind of, repo rates, go to the moon, that's when the Fed had to come in and step in. So what really happened there was we had $1 trillion deficit during an economic expansion, 5% of GDP, roughly, during a never seen before. The closest thing was, 2% of GDP in the 60s. But this was, a result of the corporate tax cut, which forced the Treasury to go, okay, now we need to issue an extra $1 trillion a year in debt. And there just wasn't a market for that. There wasn't enough buyers for those Treasury bills. And so it turned out the only people who were really buying those Treasury bills were hedge funds who were leveraging, up to the hilt, very similar to long-term capital management. Right. When that started to unwind, the Fed had to come in and say, okay, we're going to prop up the repo market, and we're going to start buying Treasury bills because there just isn't a natural market for this. And so to me, that was when QE of the past was, we're going to just try and prop up asset prices. QE in 2019 changed to where the Fed said, we have to start monetizing the debt. There just aren't enough buyers. Yeah. And so to me, that's when MMT started. And a good example of, you see the balance sheet, the debt issuance and the balance sheet go in the same exact direction, right? Last year, we saw $3-4 trillion worth of stimulus. How far did the Fed balance sheet have to expand? $3-4 trillion, because there aren't natural buyers through that. So the Fed is saying, we're just monetizing everything. And even Jay Powell has said to Congress, do what you have to do, we'll monetize it. Right. To me, that is fiscal dominance, where the Fed is now subject to the Treasury. And it's perfect, let's put Janet Yellen in charge of this, because now Jay Powell is essentially subservient to her. Whatever we're going to do with the Treasury, you guys have to monetize. And to me, that's really important, because that's a jumping off point to something we've never seen in this country. Right. Where we're going to print money to pay for whatever the country wants to spend on, whether it's infrastructure or just helicopter money, sending checks to people. We're doing all of this right now. And it opens up the possibility of runaway inflation. And to me, that's why I'm watching the dollar, because if the dollar goes down against these other major currencies, it's a sign that people are losing faith in the value of the currency. and that could create an inflationary spiral, which would be very painful for a lot of reasons. And so I think people don't appreciate that risk is real today, and it could have major implications for markets and the economy.
Do you study the politics at all? Because I don't, I enjoy the economics and kind of thinking through and the thought experiments, but I don't really get into how the politics work or how they function. And my point there is, if we've got Janet Yellen now, and basically she's Jerome Powell's boss and tells him kind of what to do, I guess technically there still could be a hang up, because Congress has to approve this, and this has to be approved, and this law has to be voted on, and down the chain. I'm not really sure how that works, but then I guess the counter in my own mind is that I'm saying, well, now the Republicans really aren't fiscally conservative at all, so they'll most likely go along with anything that Janet Yellen wants to do, but they'll say, we just want 75% of it. I mean, but have you thought through how the political process works? And if we're moving in the next 4 years, it's going to be a lot easier for Janet Yellen to get her way and just act big, as she says.
Well, I think this is why the markets probably have not appreciated the ramifications of the blue wave that we saw, with the Democrats winning the Senate seats in Georgia. Because this does make it easier for Biden to just implement whatever he chooses to implement. But to me, that doesn't matter, as it's more likely he'll get infrastructure passed now, which is potentially $3 trillion of new spending on top of everything, which is probably more of it's a much smarter way, I think, to use MMT than just sending checks to people. But I do think what we saw, to me, it's really apolitical. I think there is a bipartisan consensus that MMT is the way forward. You saw it with the last administration, Trump saying, okay, well, I want the Fed to lower interest rates to zero and do QE, and that's so that I can cut taxes. Right, that's kind of the right's version of MMT. The left's version of MMT is, okay, well, we want to do things to give people jobs and et cetera. I don't think there's any debate on whether to do MMT. I think there's already a consensus that because interest rates are so low, because we haven't had any inflation, that we can get away with printing money and spending, having the Fed monetize whatever we want to spend on. Now, I think the only debate is whether that should be for tax cuts or that should be for helping the working class through types of job opportunities and things.
Yeah. So I know we're getting short on time, so that takes me to my last question here, and I really want to get your opinion on commodities, because it's another thing that I've been trying to think through. And we talk about all this money printing. You say, my goodness, you got to have some type of hard asset, and some of those commodities do well with even the left's type of infrastructure spending or the Green New Deal. And I loved commodities back in March, but now you've seen copper and a lot of other things really have a run. Last time I checked, oil was around 50, 52, something like that. So do you think that, what's your long-term view on commodities first and foremost? And do you think that right now it's a good time to look at them, or maybe just there's too much emotion and then maybe they're overbought right now?
Yeah, I think we are in the very beginning of a new commodity super cycle. I think you see these things move in big waves, and I think over the last 40 years, you've generally wanted to own financial assets over real assets. Financial assets since 1980 have outperformed everything. I do think we are at a turning point here where financial assets are not going to be the primary way, to make money over the next 5-10 years. It's going to be, you want to focus on real assets. And, that's types of real estate, that's commodities, that's precious metals, those types of things. I do agree with you. I think in the short run that, a lot of these commodities may be overbought. And I think we do have some deflationary risks over the next few months with rolling lockdowns and things in different places, and that could cause a correction in a lot of these things. But I wrote a piece about energy, the energy sector, traditional oil, back in September, October. Since then, a lot of those energy stocks are up. They've literally gone up 100% in the last 2-3 months. And so I do think a lot of those are overbought. But I do think oil prices, especially are the ones that I'm most interested in. I think we could see, over the next few years, oil shortages and things that are totally unimaginable to people today who think oil's done. We're never, we're going to stop using oil and we're never going to need it again. We've seen so much, production shutdowns of, shale oil in the U.S. that when the economy reopens, we could see oil prices, scream higher. Now they've rebounded really nicely already. So, like I said, over the next few months, it's kind of iffy, but I do think, we probably, commodities are a much better bet than financial assets over the next 5-10 years.
Makes sense. Yeah, I think one of the biggest mistakes people make is they get hyper focused on the demand and they completely forget the supply side of the equation. You can have demand go down, but if supply goes down faster, you still have prices going up.
Yeah, so you see, so in oil, it's interesting. We've had, so much production shut down, and then think about the pent up demand for energy. So, everybody thinks shale, is going to be able to meet those demands from, pent up demand once the economy reopens. But everyone's going to want to drive, visit family, fly, go on vacations, all this stuff. Where's all that product going to come from when the economy reopens? It could be very, very bullish for energy.
Yeah, and you have less capital going into new production because of ESG and that whole.
Absolutely, and that's what people don't get. Is there's so much money going into new energy, alternative energy. That means it's mathematically certain the returns from those things are going to be worse because there's so much capital flowing there. There's been no capital flowing into energy over the last month, 2 months, and there's so much angst towards even allowing that what people don't appreciate is, okay, the more ecologically sensitive you get in terms of economic policy and all these things, the more the oil price is going to go up. If you take away capital from it, that means oil is just going to get more valuable. And so that's actually, people think, well, everything's going ESG and all these countries around the world are going to be anti-oil. Well, that actually right there is probably one of the most bullish things for the oil price you could imagine. They're going to ban, oil drilling and all these things. It just makes the oil price go to the moon. So, it's interesting.
Yeah, it's a great lesson to end on. Jesse, thank you so much for your time. I always enjoy the opportunity to talk to you, and I love listening to your podcast. For my viewers who want to find out more about what you do, where can they go?
Yeah, this is a lot of fun, George. Thanks for the invite. Thefelderreport.com is my website. I try and put up a blog post there once a week, unless it's a podcast, which is more like once a month. But I'm pretty active on Twitter too, at Jesse Felder, and I've shared a ton of reading and things that I'm doing there.
All right, Jesse, enjoy the rest of your day, buddy. Can't wait to do it again.
Thanks. Take it easy.